The chairman of the Federal Reserve, Jerome Powell, announced a quarter-point interest rate hike today. That means the range for the Fed's benchmark rate is 2.25% to 2.5%. Now, this is the fourth time rates have increased this year. The Dow was positive to start the day, but has since dropped sharply since the announcement. Joining us now from Washington is AP economics writer Josh Boak. Josh, thanks so much for being with us. Explain, if you will, the rationale by the Fed for this most recent rate hike. I mean, are we supposed to assume the economy is good, it's healthy, that's when you raise rates?
That's exactly it. The Federal Reserve's job is to maximize employment and keep inflation at roughly a 2% target. So it looked at the stronger economic growth of this year, the hiring gains, and decided it needed to raise rates 4 times. It signaled this latest increase repeatedly to the market. So none of this was a surprise. It had been priced in. But what the market was looking at today was the future path. And Jerome Powell, the Fed chair, came out at his news conference and said that path is uncertain. And that's leading to some turmoil as people are trying to figure out what's going to happen in the economy in 2019 and 2020.
Oh, okay, so let's look ahead to 2019. Is there some indication that the Fed won't raise rates as frequently as it did this year, or do we not even have that clue?
Fed officials are suggesting 2 rate hikes next year. That's down from 4 this year. More importantly, it's down from the 3 rate hikes that they forecasted in September. So they're expecting fewer rate hikes. But the bad news is they're expecting lower growth. Growth this year is supposed to be about 3%, but Fed officials are saying the economy will grow next year at 2.3%. So less growth equals fewer rate hikes. That's how the math works.
But it does seem to all make sense. So I'm still a little surprised that the market reacted to this news as if it was sort of sudden and unexpected, and as if there is so much uncertainty.
Well, there's uncertainty because these are expectations. They're not prophecies. They're not even as well informed as some fantasy football projections. The reason why is there are so many variables at play. You have a global economy that's seen a slowdown. You saw protests in France sink that economy. You've seen Germany struggle to adapt to some auto supply issues. You've seen the United States and China engaged in a trade war. All of that can affect growth in ways that are difficult to model and difficult to expect. Many economists expect not just a slowdown, but the possibility that the U.S. economy could be on the verge of a recession by the end of 2019. All of that creates the uncertainty.
Right. We have been hearing those dire warnings for sure. Now, Josh, I want to ask you ultimately, what does all of this mean for the average American when it comes to borrowing money for things like mortgages or cars?
So what the Fed does can influence the financial markets, most notably the 10-year U.S. Treasury rate. Now, when I last checked, as Powell was speaking, that rate was dropping, which means your mortgage rates should be slightly lower next week. However, as the Fed has been raising rates and as the U.S. has had more deficit spending, mortgage rates have jumped over the past year. And because of that, home ownership has become much more unaffordable for many Americans, and some people who might otherwise sell their homes are saying, I might as well stay in place. Auto loans would be more expensive. Now, the supposed benefit would be that economic growth would be stronger and you'd receive more pay raises. And while pay's up this year relative to where it was a year ago, it might not make the difference if you're making a major purchase.
And wouldn't any savings you stash away in the bank then rise faster if there's a higher interest rate for savings?
Sure, there would be higher interest rates for savings, but the interest rates that are often paid on savings don't match inflation. So it's not like you'd be making a fortune out of that. Most people have made their money because of a stock market boom after the market bottomed out in March of 2009.
Right.
The market's gone up by about 250%, and we've seen it decline so far at about 5% this year. So you're still better off if you were able to hold on, but most people really made their money that way through Fed policies rather than through higher rates.
All right. So the president has very publicly bashed the idea of increased interest rates. Chairman Powell was asked about this today, and here's how he responded. Let's listen.
I'm not worried on the first question, because I know and everyone who works at the Fed knows that we're going to do our jobs the way we've always done them. And that involves, getting the best thinking together, diverse perspectives. Every business, every FOMC cycle, we talk to hundreds of people in all different parts of society, not just business people or market people, but people from community development organizations. We get survey data from thousands of people. And so we really do have a pretty broad exposure to what's going on in all different parts of the country. And we're going to take all of that information in, and we're going to make the best decisions we can, and nothing will cause us to deviate from that.
So, Josh, Powell is essentially saying that the president has no influence over him. Is it unusual for a president to publicly criticize his Fed chairman?
It is unusual in this current era, but it's not surprising. The Fed wants political independence so that it can make decisions that in the moment might be unpopular. You might remember during the financial crisis and the initial stages of the recovery that were very weak, Texas Governor Rick Perry said then Fed Chairman Ben Bernanke would be treated real nasty if he went to the Lone Star State. Bernanke persisted in his policy. Politicians often criticize choices made by the Fed, but the important thing is not the criticism so much as whether or not the Fed can maintain its authority with the financial markets and with employers by showing that it is independent of these political considerations.
Right, because we'd like to all believe that the Fed is making its decisions based on economic realities and not on, which way the wind is blowing in the political realm.
The Fed is trying to play Moneyball in an era where a lot of scouts are saying, well, here's how this looks or here's how this feels.
Right.
And so sometimes that's a little bit different from the political dialogue. The question really ultimately is whether the Fed has done its math right rather than whether or not it bends to political pressures.
Absolutely. All right. Josh Boak, a pleasure speaking with you. Thanks so much.
Thank you.